Welcome everybody. This is Craig Nickerson from the National Community Stabilization Trust, and I'm joined today by some other important presenters, Tyler Van Gundy and Ulyss Leapins from Forsyth Street Advisors, fund managers that work on interim financing. Mark Stallsworth from the NHS of Kansas City, he heads up that organization, and Glenn Hayes with the NHS Neighborhood Housing Services of Orange County, California, who heads up that organization. And of course we have our HUD partners with us. I believe John Laswick, David Nagara, and Hunter Kurtz are all with us, so we're delighted to have them here too. So we're going to talk about interim financing today. And let me see if I can move my slides here. Bear with me a second. Here we go. There are those names I mentioned. This is the third of 3 sessions that HUD had arranged for us to present. And maybe some of you, likely many of you, were on the first 2 sessions. The first 2 focused on mortgage financing, the dilemma that many of you are experiencing in finding adequate access to mortgage capital for your home buyers once you have acquired and renovated property. And we had a good in-depth discussion of that. Today we're going to talk about what happens prior to that need for mortgage financing. How do we make available capital in addition to the NSP funds in order to acquire and renovate these properties, the foreclosed and abandoned properties? Our objectives today are pretty straightforward. We want to provide an overview of how interim financing, what it entails. We want to discuss the pros and cons of interim financing for acquisition rehab, the costs involved. We want to make sure that we explain when and how it's right for you. When does interim financing for a local NSP grantee or sub-recipient make sense? And certainly identify some ways that you can obtain interim financing, where to look for that money. Is it locally? Is it nationally? Is it private? Is it public? And then, importantly, we have Mark and Glenn on the phone to add some local validation to this. Both Glenn and Mark have a lot of experience in working on acquisition rehab and accessing interim financing, short-term financing for a number of purposes. So we're going to call on them on a couple of points here to ensure that we're being relevant to all of you that work on this on the ground. A little bit more background here. HUD had asked us last summer, actually it was last spring, to put together a number of important materials and a series of roundtables on the whole issue of financing. They heard from you that there were some real issues with respect to mortgage financing, interim financing, and wanted to make sure there was more material available on that topic. So Enterprise Community Partners and the National Community Stabilization Trust, the organization that many of you work with to access REO property, facilitated a discussion throughout the summer in 6 regional sessions. You can see the locations there on your screen. And we had a very active, interactive discussion principally around mortgage financing. Typically around 25 people in each session. About 6 or 7 or 8 of them would be from the lending community or from Fannie or Freddie, and the rest would be NSP housing providers. And there was a richness of discussion there that has now translated into a mortgage guide that will be soon out and available to everybody from HUD. But the other project that we undertook was to look at interim financing and better understand where it was being used and if it was being used to help facilitate this acquisition and subsequent renovation of REO properties. So we did an assessment that preceded those roundtables. This now is probably, it's 8 months old, but I think it's still very interesting and relevant to this topic. We found, for example, that out of the 174 NSP respondents, that 9%, only 9%, were using interim financing to fund NSP projects. I think it'll become abundantly clear that that number has to go up if we're going to be successful in getting to scale and restabilizing our neighborhoods. Secondly, we found that over 60% of the respondents to the survey relied solely on NSP and other government subsidy funds to support their NSP efforts. There wasn't a whole lot of leveraging going on. And there are many reasons for that, of course. The need to deploy the capital, the NSP dollars, the need to sort of build the foundation of what you're doing at the same time that you had to actually be doing the acquisition and renovation. But only 60%, over 60%, only used those public subsidies. Third, we discovered that about 15% didn't know anything about interim financing. I could probably not have defined the term. And then lastly, over 55% did want technical assistance, some advice from HUD on how to better secure interim financing. So that certainly said to us we had some work to do in trying to explain things. There is a interim financing primer going through its final stages of drafting and review that should be out shortly, I would think within the next 30 or 45 days. I'll defer to HUD on that in a minute here. But let me just try to define this term for you first, and then we'll move into some of the substantive details. How are we defining interim financing? We're defining it as the use of capital, typically from a private lender. It doesn't have to be. It could be from another source, a national intermediary, a philanthropic interest, but a use of capital for short-term development, such as the acquisition and renovation of single-family properties. That money would then be, of course, repaid with long-term financing, such as a 30-year fully amortizing permanent mortgage to the home buyer who's buying that now fully developed property. NSP is the second bullet on this slide here. I think it's important to emphasize. NSP and other public funds, it doesn't replace the NSP funds. It really does help it go further. And those NSP funds, as you'll hear later, can be used in a number of ways. It can be used to credit enhance and therefore free up some of that capital from the private sector. It can be used as some form of subsidy to induce the engagement of that private investment, to fill the gap, if you will, between what is economically viable for a lender and what is necessary to make these deals actually work. In terms of the advantages, and we'll go through this in more detail, but just at the high level, let me mention a few of the key things, the key reasons I think you'd want to increase your access to interim financing. First, it may allow you to access funds earlier in the development process. Now, you can access your NSP money pretty quickly these days, but sometimes having that line of credit available and accessible to you within, hours' notice is important. Even more important, though, is increasing the total amount of funds available to you. If you could use that limited number of dollars in NSP to go further, wouldn't that make sense? That's certainly important. And then preserving your NSP funds. We've got to rely more and more on program income now, and to the extent that we can make that money go further, that will certainly be important to us. And that'll help us with the stabilization efforts even when we've exhausted NSP down the line and we're just relying on program income. And then importantly here, and I really want to underscore this last bullet, it's really important, I think, for the sustainability of what we're doing here in our neighborhoods to engage the private sector as early as possible in this effort so they understand it, they're willing to work with us, they contribute their capital because they're now knowledgeable and they realize it's not a high-risk venture, it's actually a good investment for them. We need to kickstart that happening, and we simply can't rely on a scenario where 60% of grantees are relying solely on the public subsidy to do this important acquisition renovation work. I'm going to pause here, and I don't want to put our HUD leaders on point here, but John or David, if you might want to speak to this source of capital going forward.
Yeah, Craig, I think you're right. We agree with you on the value of these things, and I think everyone's aware that their income stream, wherever they started out, is dwindling. NSP 1 was $4 billion. NSP3 was $1 billion. So you have to get more mileage out of that. And as you mentioned earlier, there were some incentives to spend or obligate all the NSP funds first, and that was an understandable sort of conflict. But I think now that most of us are past those deadlines, we can start to think about how do we leverage this money, and how do we get farther down. How do we do more houses? I mean, we're talking in the overall $7 billion worth of NSP of roughly 100,000 homes. So that's $70,000 a unit on average, spread across the whole country. If Congress gets to the point of considering additional funding for Project Rebuild, and we understand that Senator Reid is about to introduce legislation to that effect, if we could get that number down to $60,000 a unit by pulling in additional financing, it just improves the chances of getting more federal funds for this kind of activity. So, but even without that, I think the smart communities have been thinking for a while about how do we stretch this out? How do we get more value out of the same amount of money? Because there's clearly more units than you're ever going to reach directly with NSP funds. So by getting more and doing more earlier, you have a much more powerful effect on the problem than if you kind of string it out and do one house and then wait to sell it and then get some money back and then do another house. And by the time you get done with that process, you really have kind of thinned out your impact. So I think the interim financing and leveraging help you to kind of move that up, make it go farther and faster with the same amount of NSP funds.
Right. Yeah. Thank you. That couldn't agree more. Maybe before I turn this over to Tyler and Ulyss for the next number of slides, if I could ask Glenn, and then I'll ask Mark as well. Do you agree with John and I that this is an important step for grantees and sub-recipients to undertake? And what's been your early experience in trying to leverage your NSP dollars? Glenn, let's start with you. Glenn, I think you're muted.
Oh.
There you go.
No. Okay. Can you hear me?
Yep.
Okay. We decided early on that we would finance the rehab cost with interim financing, and that kind of makes our things move smoother. And so we've reached out to our local supporters, and also for the Community Housing Capital Fund through that NS Stabilization Trust helped set up. So yes, we have. It helped us and it didn't slow us down. I mean, it actually made it possible for us to be the first in the nation to get 50% of those funds out, and we're now almost finished with the first pull down. But in order to meet our goal of 100 units, we do need to, get the interim financing out there and keep things moving. And particularly now, we're holding quite a few properties, and so we are we need to get those financed so that we can keep the program moving also.
Good. Well, we'll come back and hear more from you. Mark, in Kansas City, I know you've accessed capital from a number of different sources to supplement your NSP.
Yeah, we have, and I agree with Glenn. It was the critical factor up front was the process as it started up. Although I think that the city of Kansas City and HUD both did a fantastic job of getting the monies available as quickly as it was possible. That wasn't really fast enough to be as responsive to the marketplace as we needed to be. There were a lot of properties that if you had cash, things were going to happen. If you didn't have cash, things weren't going to happen. So we used our lines of credit initially up front to sort of flipped what Glenn was doing. We would use our cash for the acquisition piece. Mm-hmm. I don't know if it's the best way to do it or just the way we did it. but we were able to meet all of the requirements, all the guidelines for the NSP 1, and we're well down the road of meeting them for NSP 3. So we've had a good experience with it, and using borrowed funds and some of our own funds to make those initial transactions happen and sort of start having that impact in the neighborhoods was critical for us.
Great. Well, we'll come back to you as well. I know, Mark, you're going to be with us just for the next 40 minutes or so, but as long as you can stay with us, we'd appreciate it.
Okay.
Tyler, why don't you walk us through the next level of detail here, if you would. Tyler Van Gundy.
Sure. So we're looking at slide 9, and listening to everyone speak, there's this one major important common thread that each group has mentioned, which is they've used their financing to reduce their reliance on subsidy to cover development costs. So meaning that they have a combination strategy, whether it's using their interim financing to pay for just acquisition or to pay for just rehabilitation. Each group has figured out a way that works best for them to blend those two sources within their development process. And that's very much, it's very much a question of each individual program, what type of housing stock you're looking at and what your resources are. But that's the key aspect, which is what is the appropriate blend between those two resources to help your development process. So really, when you look at each one of these different programs, you look at the question of how can we use the subsidy within an interim financing program? And really, there's two different mechanisms to use subsidy, which is to share costs with the other sources, and/or to provide credit enhancement to the interim financing to basically bring that financing to the table. And we have a couple of different examples here to cover 50% of acquisition and rehab costs, or to cover only rehab, or to use the subsidy as just gap financing to cover the portion of the development costs for which other sources aren't available. There are many different iterations that can be created within each program, but really it all comes down to that initial bullet point, which is reducing the reliance on subsidy to cover all of those initial upfront development costs. Looking at our next slide, we have really what is just a comparison here of two different programs. On the left-hand side, we're looking at an all-subsidy program. And on the right-hand side, we're looking at a program that uses an interim financing strategy. Each one of these set up with basically really just a sample sources and uses. And I'm going to run you through each so you can look at the comparison for how each one operates with just using all subsidy versus having an interim financing operation. So on the left-hand side, very simply, we're looking at a project that has total uses of $150,000. So that's the acquisition and the rehab to purchase the property, bring it back up to operations, and ultimately move into a permanent phase. The development phases, the sources are $120,000 of subsidy and $30,000 of developer equity. So simply you're using all of your subsidy to pay for acquisition and rehab costs. And then moving into the permanent phase, your home buyer is expected to achieve or to obtain a first mortgage of $100,000, which means you're leaving in $50,000 of subsidy. So the immediate conclusion from looking at this first setup is that you have subsidy of $120,000 coming in as a part of the development, with $50,000 staying in as a part of the permanent phase. So there's a delta there, of course, of $70,000 of subsidy that would come back to the program to be used for later projects. Sliding over to our to our interim financing program, we have a comparison here using the same total uses of $150,000. Those are our total development costs, but we have a different source construction. We have $50,000 worth of subsidy, $30,000 worth of developer's equity, and a $70,000 interim financing, so a loan. And when you move over into your permanent phase, you see the same $50,000 worth of subsidy that stays in, and the home buyer achieves that same first mortgage of $100,000. So what you've done is you are looking at basically the same operation, the same house, the same acquisition and rehab strategy, the difference being that you now have a $70,000 loan to pay for that acquisition and or rehab, and you have the same $50,000 that goes in during or you have $50,000 that goes in during your development phase, as opposed to using your full $120,000. And what we've done here, down here on the bottom, you'll see on the last line, we have calculated the number of simultaneous property starts per $500,000 of subsidy. So we're assuming that each program has a $500,000 budget or subsidy budget that they can use to allocate across their program. The difference between these two scenarios is what you can do on a simultaneous, what you can simultaneously develop within your operation, which is the difference between doing approximately 4 projects versus 10 projects. And so this is the key metric that interim financing provides for, which is a leveraging up of your subsidy dollars to be able to acquire and rehab more projects on at the same time and have a greater impact on your geographies. There are, of course, some disadvantages to looking at to obtaining some interim financing. One of the major ones is complexity. Having a facility means you have a new source. You have a source which is, of course, debt, which brings many different components to your program, additional processes, other requirements that your lender may ask. These could be just general reporting, lender communication, and many other, depending on where you achieve your interim financing, many other basically kind of requirements of your program that will require certain staff times and other potential costs. And of course, the last bullet here, one of the most important ones is private financing costs money. There's going to be various different costs. They'll be structured differently, but of course, debt is not free. Next, I'd like to just touch on a couple of the big pieces that will add cost to your program. And all of these will be very different depending on what your specific operation is and who your lender is. But these are some of the common themes that we will all see. Allocation of staff. May need more staff just to manage what is now a more complex program. Organizational capacity. By taking down a financing line, you're, of course, expecting to be able to do more properties at once. That means more resources in terms of a staff perspective to be able to manage those additional properties. There may be upfront and ongoing fees for applications, servicing, draw fees, many other different costs that are just associated from both your and the lender's perspective to operate a financing line. Of course, interest payments. These could be on a monthly or a quarterly basis, depending upon how it's operated. But nonetheless, you will have payments to make on those outstanding amounts. Depending upon what type of structure you're using, credit enhancement may be required. This will require the posting of certain amounts of cash for the benefit of your lender. And of course, covenants. And these are important. There may be covenants that could be placed on your organization. These could be financial covenants or operational covenants. These will be legal requirements that may affect how you operate your organization. I'm going to turn it over to Lee Sleepins from my side, who will talk a little bit about the decision process for whether you should be looking at interim financing.
And you, before you start, I'm wondering if I could, this is Craig again, wonder if I could just ask Glenn and Mark on this point. There's some of the points that Tyler just raised around the cost of interim financing. How each of you did identify some of these, the allocation of staff, the organizational capacity. Where did you draw from to find the in-house expertise to do this kind of work? And Glenn, why don't we start with you?
Okay, well, lending is what we do. So we had a pretty strong staff that knows lending. We have some ex-bankers on the staff that helps always. But we really didn't have to go outside. And then we also used the strength of our board members. We have several board members who are lenders, and we called on them to work with us on that.
Great.
I would pretty much echo that. We're a lender as well, a mortgage lender and construction lender. About half of us are recovering bankers ourselves, so we've had the expertise in house. I can see where if you had to staff up to to be able to do this. It could put some stress on the cash flow, but as Glenn said, having the folks in house to be able to do this, it was pretty seamless for us.
Great, good.
And I would add that we were able to attract some grant funding to help get this thing kick-started too. So it was probably a plus to us on the long run.
Good, excellent. Euless.
All right. Well, we've heard some about the kinds of pros and cons that there are to interim financing. Obviously, there can be a benefit. There's also some offsetting potential costs. So what we're going to talk about here on slide 13 is where's the right balance? What kind of an organization does interim financing make sense for? And we've boiled it down to three things here. Number one is strong organizational capacity. Number two, strong financial status. And number three, the availability of opportunities for additional impact on your target areas. And based on what we've already heard from Glenn and Mark this afternoon, I think you can sense how their organizations sort of fit the bill here. They had board members, staff members that brought organizational capacity to the table. They obviously had opportunities to make an additional impact on their target areas, and strong enough financially to attract interim financing from a lender. So taking those components, there's some important questions to ask as you think about whether interim financing is right for your organization. And I think the place to start, the way we've been thinking about it, is you really want to make sure that you've identified a need that interim financing can help your organization to address. If you're meeting the problem, if you're able to do whatever you have to do to face the issues in your community with the resources that you have in hand, there's probably not a lot of reason for you to go out and try and add complexity and additional resources to your program. If, on the other hand, you're in a neighborhood where there are additional properties that you'd like to work on and you just can't do it because of a lack of resources, then interim financing can help you to meet that problem. Once you've identified that need, it's really important to sort of keep your eye on the ball through the process. Once you've identified a lender that's willing to lend to your organization, there's going to be a lot of back and forth, a lot of exploring from the lender's perspective to find out more about your organization, more about what you want to do, and a lot of negotiating around terms and figuring out how this whole lending package is going to fit together. And for your organization, it's really important that during that process, you keep in mind what your organizational objectives are and make sure that the kind of interim financing package you're working out with your lender continues to make sense. And then lastly, and this is something that Tyler spoke a fair amount about, there are significant costs to maintaining these lines of credit or other modes of interim financing. And those costs just aren't worth it if you're not getting anything from your facility that has an offsetting benefit. So it's really important to continue to allocate staff, continue to ask as an organization whether you're getting what you meant to get from your interim financing, and make sure that that interim financing is directed towards meeting those needs in your communities. So, where do you go if you want interim financing? The best place to start, and this is on slide 14 now, is with any lender with which you've already got a pre-existing relationship. And there are several reasons to go there first, but I think the most important reason is these are the lenders that know your organization the best, have familiarity with your structure and the kinds of things that your organization is trying to achieve. Basically, you'll start on the second floor instead of on the ground floor. If you don't have that existing relationship, your organization does have many other places it can turn to potentially get some financing. And we're going to explore those over the next several slides. So, flip over to slide 15. One of the best places to go for interim financing is to Community Development Financial Institutions, or CDFIs for short. And these are specialized financial institutions that have special expertise and are set up specifically to serve low and moderate income or distressed communities. Their mission makes them a great fit for neighborhood stabilization. And many are, in fact, engaged in providing interim financing, development financing to organizations that are doing neighborhood stabilization. These organizations are certified by the U.S. Treasury CDFI Fund, and if you're looking to actually find a list of these organizations, see whether any of them are active in your area, the U.S. Treasury CDFI Fund does maintain a site with all of their names. Another option is a local community development bank, CDB for short. And community banks are banks that are specifically serving low and moderate income communities. Typically, they're chartered by the state or federally, and will provide many of the usual retail banking services. But they do have that mission focus on the low and moderate income communities. And along those lines, many of them also are CDFIs. Next up, we've got other banks, basically just commercial banks that may have, they're usual banks, but many of them do have a interest in serving communities in which they're active, especially if they're already working with organizations that are in that community. They may be national, they may be regional, they're local. Their motivation to be involved in the community may be due to CRA or branch expansions or any of a number of other reasons. And they may have several different ways of getting involved mechanically in lending to local level organizations. They may lend directly to an organization. Alternatively, the way they may try and help out in their communities is by providing liquidity to other institutions that in turn lend directly to organizations on the ground. And then sort of a final option here, we've thrown out the Stabilization Trust REO Capital Fund, which Tyler's going to speak a little bit about.
Sure. So the National Community Stabilization Trust has set up its REO Capital Fund, and its mission is strictly to provide interim financing. It exists really to serve this market and to assist organizations that have the capacity to operate interim financing programs and to help them leverage and expand their reach with their existing resources. So the REO Fund is ultimately a subsidiary of the National Community Stabilization Trust, which was set up by some of the large national housing nonprofits. We were seeded with an investment from the Ford Foundation, and we are using these resources in a structure to support existing CDFIs, to expand those CDFIs and their capacity to lend to organizations in need of financing. So we're basically helping to provide a product and additional liquidity to those institutions and those CDFI organizations who have an interest in lending in this space. Ultimately, we're expecting to build up a portfolio and have built up a substantial portfolio and expect to continue lending within this space. And we are continually readjusting and looking at the needs, the interim financing needs, and working with a lot of different CDFIs and institutions to create a product that ultimately helps with the quirks of their individual programs.
So Tyler, can I interject here? I think, Glenn, your experience is a good one because you're actually accessing a number of these different sources here. You worked with the trust, but now you're finding some local sources that can carry on that effort at even better rates and terms, correct?
Yes. We didn't limit ourselves to the stabilization trust, but that was the really, that was there when we needed it most. But we have reached out to one of the larger CDFIs here in Orange County and on some of the regular banks that we've been doing business with. So we've spread out. We have 5 different credit lines now that we've been using for this program.
And are you beginning to see some of the community banks be more sensitive to your needs, more aware of it, and maybe CRA is starting to be the phoenix rising again? It's actually, and I don't mean the city, but are we beginning to see CRA become meaningful again?
Well, I think so. That one of the banks has already got a BEA, Bank Enterprise Award, for helping us out on this. And so that's really alerted a couple of the others who are going to be doing the same. And so, yes, it is CRA driven.
Okay. Mark, what about...
And the fact that they love us.
Of course. Mark, how about you? What are the key ingredients here besides love?
Well, love is all around, but we've seen the CRA concerns start to raise their heads. I think that as some of the banks in our area are beginning to identify some of the banks that aren't going to make the cut and are going to be ripe for acquisition. They're starting to once again be worried about the possibility that a protest could prevent them from doing that. We've actually had real good luck with some of the large banks too. We got a very nice loan recently from U.S. Bank, $500,000, and we have a smaller local bank that we have $1 million line with. We have a local CDFI that has brokered $1 million guidance line with a local bank that's looking to expand. So there are a number of resources, and I haven't come to you yet because I haven't run out of money yet. So you're on my list, but.
No, that's quite all right. I think our point here is there's many different sources to access, and it's going to vary depending on the locality, the level of engagement of your local lending community, the engagement and interest of some of the national and regional providers in your community. And the key is just trying to find access, prove your point, and then keep negotiating better and better rates for yourself so that the economics of your deals improve over time.
Hey, Craig,
John, I will say, too, that if you pay attention, there are lenders out there that will come to you. You don't always really have to go to them. There are folks that are bringing deals to us.
Did I hear our HUD friends here?
Hey, Craig, yeah, this is John. I was just going to say on Glenn's point earlier that, sometimes getting started, doing your first deal with the trust or somebody that understands NSP and all that is a good way to get your credibility established so that, when you do approach that private lender, you can say, look, here, we've already got something, this already works, we're already doing this, we just need some more money for it. And so I think that kind of sequence is, work your way up the food chain that way.
Yeah, it's a good point. Our goal certainly wasn't to be a major solution here, but be sort of a pump primer to get things started so that it works better for the long term locally with your private financial institutions. Great. Ulyss or Tyler?
Are we moving on to the sample program?
Sure, I think we can do that.
So we just wanted to touch briefly. We have some experience here in New York City, having worked with HPD. We have some familiarity with their program here. And I think the New York City HPD program is a great example of a few of the themes that we've emphasized earlier in the presentation. For one thing, it's a great example of a grantee that builds on existing relationships with lenders and expands on expertise and capacity that it's developed in the past. For another, it's a program that combines some of the elements that we talked about earlier, where a grantee is figuring out how to share costs with other financing sources and is also providing some credit enhancements. So the way HPD's program worked is they had previously, in 2006, set up an asset control area program. And in the course of setting up that program, they built up relationships with a variety of private lenders. They set up some nonprofits and some borrowing entities that would fill in some of the spaces in the flow of funds between those private lenders and actual projects. And then in 2010, with the NSP funds, HPD and the New York State HFA were able to combine some of their NSP funds to credit enhance a $32 million line of credit with a similar group of lenders. And they were able to build on that trust and that experience of what they had done previously. And then they also set up a new nonprofit called Restoring Urban Neighborhoods, LLC. And this was the borrower under the facility. And through that facility, what the borrower was able to access was a combination of funds from the private lenders plus NSP funds. So that's that sharing costs principle that we were emphasizing earlier. And this is just one example of a way in which a borrower was able to bring more resources to bear on the problem. And in fact, HPD has estimated that they'll be able to redevelop 90 properties rather than half that amount, which they would have been able to do without.
Great. I wanted to, before we turn back to Glenn and Mark a little bit here, and there was a question that came in while we were going through the deck here from Alicia Klein about does it make sense, in addition to sort of the sources we're talking about here, to leverage private developers or general contractors who can access capital as well. Has that been part of your mix? Are you looking to find developers who can deploy some of their own capital for acquisition rehab to supplement your own lines of credit?
In Kansas City, using NSP funds and bringing in private developers has not worked very well. They just really didn't know. They just didn't know the market. They didn't know the areas, and they were not all that successful. Now, having said that, what we're doing now is we're going back to some additional developers to attract them into doing projects that are maybe not in our focus areas for NSP, but that could be supportive in nearby areas, so that they can work in areas where they're more familiar and they're more comfortable. Maybe not be right in the NSP targeted area, but if we can have them hold up the sides of that area, if you will, that's a big help as well.
Now, we've talked to several developers, but we've never been able to figure out how it really fits in with NSP funding, and how do you really get a developer's fees out of that, and so on. So we've kind of shied away from that, but we are talking with developers now about what is supposedly coming down with the NSP to rental program, and we will probably need private developers involved in that if that actually occurs.
Yeah.
Right, that's where we're talking with them too, Glenn. Yeah.
Yeah, and I think, Alicia, to further answer your question, I think it's the classic "it depends." Many private developers, initially, as many of the folks on this call know, were our competitors. They were competing for the same properties, sometimes driving up the price, making your life all the more difficult. Some of them, however, I think we've converted to believers and wanting to support community stabilization, and they seem to be taking one of two paths. And I might ask John last week to speak to this in a minute, but one path is that they get involved, they split their costs between their own capital, which sometimes is more expensive, and NSP dollars in order to acquire and renovate, but they can do it efficiently, and they just need that subsidy, that gap to fill what they can't do with their own money. When they do that, of course, HUD, the NSP requirements all apply. If, on the other hand, you bring them into to be part of your army of folks beginning to restabilize the neighborhood, and you say to them, you deploy your own capital for the acquisition and renovation, we will be making available funding, down payment assistance, closing costs for subsequent potential buyers of those properties, then a lot of the federal requirements don't apply to them directly, so it allows them to be a little bit more efficient with their development, but they still have that wonderful asset of having a pre-qualified borrower who might be interested in their fully renovated property. So it's not quite the same thing as interim financing per se, but I think the question from Alicia is a good one because it's just another way to get your NSP money to go further. So let's just move on to sum up some of this, and then we'll open it up to questions from the attendees. So we covered a fair amount of ground quickly here. The bottom line here is that while interim financing can be challenging, particularly when you're first starting, and going to local lenders or going to some source to explain to them what we are doing in neighborhood stabilization. Believe me, I've got scars from some of those discussions with lenders. I would suggest that in the long run it is well worth the effort because the benefits to grantees in their target areas are considerable. That one example that we used earlier of being able to maybe do more than double the number of properties with the same amount of NSP money is something that we need to seriously look at. And we all hope there's a project rebuild or some other funding source around the corner for us, but we need to stretch our dollars and make sure that we can tackle as many properties as possible. Interim financing can also expand the breadth and depth of what we're doing. It encourages us to engage more of the private sector, the lending community. It may increase the awareness of some other segments, the realtors and appraisers, so that they're more a part of the solution rather than the problem. And all of that's important to the long run here in making sure that we sustain neighborhood stabilization.
Greg, this is Glenn. I'd just like to add that we're probably going to be saving money by getting this program finished a lot quicker than we would have if we just keep recycling the NSP dollars. And so we're going to save administrative money in the long run.
Good point. Very good point. So, Brandy, why don't we stop there and open it up for questions?
Great. I do have a question in the Q&A panel here. Our HUD NSP TA provider indicated that general contractors can also bring the equivalent of interim financing to the table and receive a portion of their payment out of sales proceeds. Have folks seen this work?
Yeah, so I sort of addressed that a little while ago. I used the term private developer instead of general contractor. It certainly is, I think, a complement to the kind of lines of credit that nonprofit agencies or even quasi-public agencies can acquire themselves. It's just another one of the tools in the toolbox, if you will. From an eligibility standpoint, I don't know if there are any cautions here. Our HUD NSP leaders, whether you have any comments there on how that's done?
Sorry, correct?
Yeah.
Yeah.
Just on this question of, and Alicia Klein again asked the question about their HUD NSP TA provider indicated that general contractors can sometimes bring the equivalent of interim financing to the table, and I was just saying that I think certainly private developers are part of the mix here, and I just wondered if you had any thoughts on that as well.
Yeah, I mean, I think whether it's a builder or a developer, I mean, when we say contractors, I think more of the, you know, the people that are out there putting the houses up or fixing the houses up. You know, any additional money is going to stretch your resources farther. But I was also thinking, you know, we've had this is the third in the series now. Last ones we talked about increasing the amount of takeout financing, and now this has focused more on the expanding your operating capital, so to speak. You can do more units, but you can't do more units if you can't sell more units, or you can't finance more units. So it takes a balance, it seems to me, too. So you kind of got to be juggling all these things. And if you can bring some developers and some builders that are kind of putting something into the deal, and some lenders that are putting something into the deal during the development process, and then you've got, you know, maybe some different lenders, or maybe the same ones that are there, you know, for your takeout, or maybe, you know, I don't know if anybody would roll, you know, that their interim into a permanent loan, but I don't see any problems with from an NSP standpoint with doing builders or developers bringing their own money in. You know, it just becomes kind of subject to all the same requirements. So
yeah, and John brings up a good point here about, you know, interim financing assumes that you're using that capital for acquisition renovation, and then there's a takeout financing at the other end. And I know in Orange County, like many markets across the country, sometimes there isn't the home buyer demand that we saw 5 years ago in these markets. How have you handled that?
Well, we do try to market to our home buyers club, but people have gone through our home buyer activities and so on. Yes, but we are struggling with selling some of the properties. We add some of the subsidy programs that we have. We have a Cal Home program that can, you know, for down payment assistance. We have a program of the Federal Home Loan Bank, and so we add those in to drive down the cost of the program. And so that's what we've been doing.
Yeah. Okay.
In Kansas City, we've done much the same thing, and have utilized a number of different assistance programs from both internally and from the City of Kansas City, City of Independence, where we're also working, and we've had relatively good luck. I think we have about 10% of the houses we've completed left. The rest of them we have sold. And unfortunately, my second conference call is getting ready to start, so I'm going to have to jump off here.
Yeah. Well, thank you, Mark. We appreciate your insights.
Sure. All right.
Bye-bye.
Craig, we are also, you know, we are going to go into a leasing program. In fact, probably starting next week. And we've worked out with HUD for a lease-to-purchase program. Yeah. And we're going to lease some of these properties and get so that they're not sitting there empty. And we will then get mortgages on those, a 70% mortgage, and then roll that money back into the program.
Excellent. I think we're about to see a major resurgence in lease-to-own as a sort of bridge between home ownership, which is the ideal in many cases, and longer-term rental. When we're dealing with single-family homes in many of our neighborhoods, having something like a lease-to-own where people might not other qualify to be homeowners today but love the property, want to stay in that neighborhood, a short-term lease-to-own is definitely going to be one of those short-term solutions. There's a question here that I'm going to try to address here from Michael Glasso, about what is the possibility of some of the funds that the state attorneys general are trying to get from national lending institutions going towards acquisition and renovation of foreclosed properties. I'm not an expert on that, Michael, but let me tell you provide my 2 cents worth, and maybe others on the call can add to it. This very prolonged negotiation between many of the state's attorneys general and some of the top financial institutions in America, I think, is nearing a completion. A lot of the discussion has been around loss mitigation, modifying loans, increasing the emphasis on principal reduction as a solution, which is not commonly undertaken. But I think the key here is that to date I haven't heard much about some of that money being dedicated for a supplement to NSP. It would be a wonderful idea. Just not sure how that gets into the discussion, or maybe it is part of the discussion. We just don't know. Those are discussions being held behind closed doors. Anyone else have thoughts on that good question?
Well, only to note that in a State of the Union address last week, the President announced a new commission to look at these questions, and I think from what I've read in the newspapers, it seems like that's going to maybe beef up the existing Attorney General's discussions, so that while they were talking about maybe a $20 billion settlement, a number of the bigger states didn't think that number was right, and so maybe that'll go up and increase the chances that some of that will come back to NSP. I don't know or whether it all ends up in controls it, but it's certainly a sort of an appropriate match to NSP, in the sense that some of these problems led to the ones that we're trying to create. So
yeah,
the houses we're trying to fix.
So if any of you live next to an Attorney General, please reach over the fence and talk to him or her.
So just a quick reminder, to ask a verbal question, please select the hand icon at the bottom of the participant panel on the right-hand side of your screen. You will be placed in a queue, and I will identify you and unmute you. After you've asked your question, please deselect the hand icon. You may also post a question in the Q&A panel by clicking on the question mark icon located on the top of the screen in the floating toolbar. We do have a few more questions in the Q&A panel. Will the final draft of lending program for subsidy and interim financing be made available to NSP2 awardees?
I'll ask. I think what you're asking, Sandra, is this interim financing primer that we mentioned at the beginning of the webinar. Will that be made available? And that is my understanding. I'll ask David or John to speak to that.
Yeah, we're doing some final revisions on them, and looks like the interim financing guide will be available probably by the end of this week, which is tomorrow. And the mortgage guide we hope to get out in the next coming weeks.
The next question is, will there be a documented program designed for interim and subsidy financing that NSP grantees adopt?
It's hard to come up with one program because there's so many variables in terms of the economics locally, the availability of capital, the price of that capital, and it's ever changing. The goal we had with this interim financing primer that David just mentioned is to provide some templates of how it works and how you might structure it. And so I think you'll find that very helpful. But we really found it difficult to come up with one template. I would say this though, it is, and the HUD folks may want to speak to the technical assistance that can be provided in this regard, but it isn't rocket science to develop interim financing. Many of your lenders do this all the time. Many of the major banks have their capital provider side that are very engaged in this and can help you. And even if it's just going in to say, how might I best go about this? And so I think the key here is to begin the discussion, talk to some of your colleagues in other communities, talk to the TA providers, talk to us at the National Community Stabilization Trust. We'd all be glad to help in showing you what those initial important steps are in developing a program that might work. And as Glenn Hayes said earlier, it's not like you're going to develop one program and it stays the same. It's an evolving process where you're constantly looking to improve your cost of funds and flexibility in the use of those funds.
Right. The other thing I'll just add is that to the extent that there are any of you grantees on the phone that are interested in setting up an interim financing program and you're not quite sure where to get started, feel free to submit a request assistance, technical assistance, and we'll try to pair you up with one of our TA providers who can sort of walk you through that process and get you going.
Yeah, we just approved the second round of technical assistance funding. So once those contracts are in place, I mean, we have money now, but we will continue to have money for this. But I think Craig makes a good point. And we've thought about, maybe kind of coming up with a loss reserve, agreement or something like that. But even among the ones we've seen, they're just so different based on the local circumstances and what the lenders want and so forth that I think it probably makes more sense to go to the lender and say, well, if we wanted to accomplish something like this, how would you like to set it up? Because instead of trying to sort of force them into your model, it's probably going to be a lot easier to follow their lead to get to the same place.
Next question. How well does interim financing work when the housing retail market is too depressed to recoup rehab costs, i.e., City A invests $100,000 in rehab, but home appraises as completed for $80,000?
It's a great question. I'm going to see if Tyler and Euless want to speak to this as well, but let me give you my 2 cents worth. This is Craig. That's precisely why I think this kind of interim financing can work. What's historically happened over the last 3 years of NSP 1, 2, and now 3 is that many cities, in your case City A, invested maybe $20,000 in the purchase of property, another $80,000 in the renovation of the property, so you've got $100,000 invested in the acquisition and renovation, and yet the after rehab value appraises only at 80. So that's not going to work. You can't go to a bank and say, would you lend me 100 and I might be able to give you back 80. But the problem has been, it's not a problem, but the scenario that's been most commonly used is to spend all public money for the acquisition and the renovation, 100, and only get back that 100,000 when, or 80,000 of it at some future date. With interim financing, you might be able to borrow $80,000, only use $20,000 of your public money, your NSP money, as gap financing in order to make that work. In that scenario, you'd be able to do 4 times as many or 5 times as many properties. So it's not a question of I can't access interim financing because my after rehab values are so low. It's really a function of determining what those numbers look like and then determining what level of NSP subsidy you need to engage that private capital. Tyler, Euless, any thoughts there?
I was going to say that's actually a great question because when we look at these types of financing, basically facilities, that's actually the first question we want to understand, which is what does the local market look like, and how much financing could we provide on a per unit basis? More often than not, this is the scenario. And so really this is the question, and these are the sources and uses that we want to understand, because this is going to define whether you have a 50-50 split between your interim financing and your subsidy, or a 75-25% split, and it's really a function of the strength of the local market. So this is exactly the question, and in fact, more often than not, the first question and first analysis that we're ultimately going to want to look at to understand whether an interim financing program is feasible.
At this time, I no longer see any questions in the Q&A panel or any raised hands.
Okay. Well, if not, maybe we should just remind people of the resources. And I think many of you are familiar with these links here. They're provided at many of our webinars, but here are the ways that you can access some of the information being provided by HUD. I see we have one more question, Brandy. Do we have time for that?
I'm not seeing the question. Go ahead.
I'm seeing it from Alex Kinchin, and it's how will leverage funds fit into the NSP area benefit? Alex, I'm not quite sure I know, but maybe someone else on the call can answer that. How will leverage funds fit into the NSP area benefit?
Well, I mean, the NSP money has to, every dollar has to meet a national objective, either through area benefit by, in some cases, demolition or some improvements, but most typically by having an income-eligible person occupy a completed NSP house. So when you use 100% NSP funds to accomplish the objective, you still have to meet that requirement. If you use 50% NSP funds and 50% private funds, you still have to meet a national objective with every unit that you have NSP funds in. So this wouldn't be a way to necessarily branch out. I mean, if you could, I think Craig mentioned earlier that you could, say, attract some developers or Glenn perhaps that, work in an adjacent neighborhood where they are already working, but anytime they're using NSP funds or you're matching up with NSP funds, then all that's going to be treated as basically as if it were NSP money in terms of national objectives. So, I mean, it's sort of a mixed blessing. I mean, you're getting more money, but you still have to treat it as if it's federal funds in a number of respects.
If nothing else, money you've leveraged with NSP is a sign of success. It shows that the market's coming back, that other investors are willing to deploy their capital, admittedly perhaps because NSP is making it more financially viable, but that is an early sign of success here. So we fully expect that not only for the reasons we mentioned in terms of increasing the impact of your dollars and make your money going further and getting the capital markets involved, it is one way that we are beginning to restart the engines of what used to be before the housing market collapsed so compellingly. Well, I think that covers what we wanted to address here today in terms of interim financing. So we've talked in the last three webinars about mortgage financing and how to work with the GSEs and FHA and your local lenders to better access mortgage capital. We talked today about how do we use that short-term money to acquire and renovate properties, supplementing your NSP dollars. And I want to thank Glenn Hayes from the NHS of Orange County, California, and Mark Stallsworth from the NHS Neighborhood Housing Service of Kansas City for their engagement, and Tyler and Euless from Forsyth for their help, and of course our friends at HUD for all of their insights.